Recent news has sparked a heated debate about the cryptocurrency's potential for long-term growth and its ability to fund dividend obligations. We'll start with Michael Saylor, the co-founder of Strategy Inc., who claims that if Bitcoin grows at an annual rate of 3.3%, its capital gains can theoretically cover dividends on its preferred stock indefinitely. This statement has garnered significant attention, with some experts questioning the reliability of using BTC gains for consistent dividend payments, given the cryptocurrency's history of posting negative annual returns. On the other hand, Peter Schiff, a longtime Bitcoin critic, has pushed back against Saylor's argument, stating that it assumes dividend obligations won't increase over time, which he believes is inevitable. This counterpoint highlights the complexity of the issue and the need for a nuanced understanding of the relationship between Bitcoin's growth and its potential to fund dividend obligations. Furthermore, Strategy Inc.'s recent decision to sell some of its Bitcoin holdings to raise cash has raised eyebrows among investors and critics alike. The company's announcement of a Bitcoin monetization program, which allows it to sell its BTC to raise up to $1.25 billion for various purposes, including paying preferred dividends and interest on debt, has shaken investor sentiment. As we delve deeper into this story, it's essential to consider the potential implications of Bitcoin's growth on the stock market and the companies that invest in it. We'll examine the arguments for and against Saylor's claim, as well as the potential risks and opportunities associated with investing in Bitcoin and related stocks. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone, folks. We're diving into a fascinating development that's making waves in the world of finance and technology. I'm sure many of you have heard about the launch of Trump Accounts, a new initiative aimed at introducing young Americans to the world of investing. This program, which went live on July 4th, allows children under 18 to own custodial-style traditional IRAs, with investments limited to low-cost index funds and ETFs tracking broad U.S. equity indexes. Now, what's particularly interesting about this story is the impact it's having on certain stocks, notably Dell Technologies. The company's founder, Michael Dell, was present at the Oval Office ceremony marking the launch of Trump Accounts, and President Trump himself gave a shout-out to Dell, telling Americans to go and buy a Dell computer. This endorsement has sent DELL shares soaring, with the stock closing above its 20-day moving average. But let's take a step back and examine the bigger picture. The Trump Accounts program is estimated to generate between $80 billion and $900 billion in long-term asset accumulation for lower-wealth households over the next decade, according to a McKinsey study. This could have significant implications for the stock market and the economy as a whole. As we always say on the Riskwiser Zone, it's essential to separate the signal from the noise. While the presidential endorsement has certainly given Dell a boost, we need to consider the company's underlying fundamentals and growth prospects. With its strong financials and expanding AI server revenue, Dell may indeed be an attractive investment opportunity. However, it's also important to remember that past performance is not necessarily indicative of future results. As investors, we must always do our due diligence and consider multiple perspectives before making any decisions. So what can we take away from this story? Firstly, the Trump Accounts program has the potential to democratize access to investing and promote long-term wealth building for younger Americans. Secondly, the impact of high-profile endorsements on stock prices can be significant, but it's crucial to look beyond the headlines and focus on the underlying fundamentals. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's dive into a fascinating development in the tech world that's got everyone talking. The global AI boom has thrust CPUs back into the spotlight, and it's not just the usual players like Intel and AMD dominating the scene. New challengers like NVIDIA, Qualcomm, MediaTek, and others are stepping up to challenge the status quo in the AI data center (CPU) market. This shift is largely driven by the growing demand for artificial intelligence and machine learning capabilities, which require powerful processing units to handle complex computations. As a result, companies are investing heavily in developing custom CPUs tailored for inference, the process by which models respond to user queries. One notable example is SambaNova, an AI chip startup that recently raised $1 billion in a late-stage funding round, valuing the company at $11 billion. This significant investment will enable SambaNova to expand its capacity, scale deployments worldwide, and continue investing in chips, systems, software, and full-stack AI infrastructure for customers. Meanwhile, established players like Intel are also making strategic moves to stay ahead in the game. The company has partnered with SambaNova to deliver affordable inference solutions for AI-native companies, and it's rumored to be increasing its stake in the startup. As the AI data center CPU market continues to evolve, it's essential for investors to keep a close eye on these developments. With new players entering the scene and existing ones adapting to changing demands, there are potential opportunities for growth, but also risks associated with this rapidly shifting landscape. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.